Hi, everybody, and welcome to today's webinar entitled Pensions Update, Opportunities and Challenges Ahead. The webinar today is going to focus on probably the pensions topic that's on everyone's mind at the moment, bearing in mind that it's due to come on board later on this year, and that's auto-enrolment. But before everyone breathes a selective sigh of not another webinar or a talk on auto enrollment, I hope that today's talk will be somewhat different in that I've got a panel to assist me today who I think will add a different spin on the typical auto enrollment presentation. And I hope it will give employers, trustees, and anyone involved in the pensions industry a practical guide as to what to expect in the coming months, issues that may arise, and pointers in relation to potential solutions to those issues. So I'm delighted to be joined today by Caroline Rowan, who's Head of Retirement Consulting in Aon, and a fellow partner of mine, Catherine O'Flynn, who is an employment partner who works with me in the employment benefits team. So delighted to have you here today, Caroline and Catherine.
Thanks, Stephen. Looking forward to the event.
Thanks, Stephen.
Okay, so I suppose, as I said, this webinar, what I want to do is focus on kind of some practical elements of auto enrollment. I think we've gone through the whole debate of, is this a good thing? Is it a bad thing? Whether we think it's good or bad, whether it's required, whether it's a nice ad, is the state pension enough? It's coming, and it's going to come on board. The 30th of September is the date. Now we'll discuss that a little bit later in relation to whether there may be slippage from the rollout date of 30th of September. But I think irrespective of that, I think we now need to focus on getting our respective houses in order for the rollout of auto enrolment and to prepare ourselves, our employees, and our systems really to make sure that we're in a good place come August for the rollout in September. So I suppose just to put a bit of context, and the next slide that I have here really highlights where we're coming from. Like, why is auto enrollment needed? So I'm going to skirt over these issues because, as I say, I think we've been here before, but it's no harm to kind of revisit it. Why do we need auto enrollment? What's the current position in terms of the design, which is now set out in an act? And I'm going to go through some helpful Q&A that the Department of Social Protection have put out in relation to practical elements of auto enrolment. I'll look at the design, which I think we're all familiar with and how it will work, to be honest with you, but I think it's always helpful to just clarify who is auto enrolment going to target and what is it going to mean financially in terms of contributions. I've got a potential issues that I'm going to flag. Now, this is the slide that's grown legs over the previous number of years, and I've added to this extensively over time because I think certainly I know Catherine, because myself and Catherine would deal with a lot of employment pensions issues. We're seeing a big increase in the amount of queries in relation to auto enrolment, and those help to flag issues for us that are causing employers some concern. And then my final slide is going to just highlight what we're doing, where we're heading towards, and how can we learn from the UK. So I'm just going to touch upon the UK experience because they recently they had another paper brought out in relation to their experience of auto enrolment, because it's been in place for roughly a decade now, I think, in the UK. And can we expect to see the same issues arising? So next slide, please, Sinead. All right, so why do we need auto enrolment? Well, number one is there's pressure on the state pension. I think there was an article even in yesterday's Irish Times that highlights that there's a large number of individuals who are going to be retired without sufficient funds to meet the lifestyle that they hope to lead. So you're seeing increased pressure on the state pension in terms of what the pension can afford. For instance, as I'll discuss later, we're moving towards a generation of renters as opposed to homeowners. So is the state pension sufficient for an individual to pay rent and to live on? Probably not. So you're seeing an increased pressure on those individuals who rely solely on the state pension in terms of their life going forward. So auto-enrolment, by and large, is looking at improving the situation for that cohort of individuals. Ireland has typically a low pension coverage, so 34%. Now, in a previous life, I worked in a life office as well, and there were various efforts made at trying to increase that pensions coverage. For years and years, I mean, one of the key issues, and those in the industry will know this well, that pensions was seen as a somewhat dirty word. Nobody wanted to talk about pensions. That's something to be addressed when you're 50, 60. But unfortunately, when you're 50 or 60, it's too late to really undo the damage of the previous 30 years of savings. So we've had typically low pension coverage. Lots of ideas and how that can change auto-enrolment. There's some good ideas with it that I think will assist in people's buy-in to it, that I think can also be adopted in the private pension sphere as well. For instance, if you look at apps like Revolut, they've kind of revolutionized the way young people have engaged with their finances. Bitcoin and whatnot, no matter what we think, whether it's good or bad, what sort of investment it is, that sort of investment has led to people more openly speaking about investment matters. So low pension coverage, is that something that would have increased on its own, given the way younger generations have embraced financial matters? Maybe, but auto-enrolment certainly aims to increase that. Living longer, it's a good news story, but it's bad in terms of pensions provision. Because if you look at a basic pension, it's going to split into the three areas of one's life. So 1/3 studying, 1/3 working, 1/3 in retirement. That split isn't quite so even anymore. We're seeing a longer final split in terms of retirement. So we need more finances to actually pay for that. Generation of renters. Now, when I was in the Pensions Council, we actually did a very good paper, which is on our website, which highlights the integration between home ownership, renting, and pension needs. So it is an issue. It's something I think that everyone's aware of, that the moving kind of aspects in terms of home ownership towards rent and the impact that that will have on individuals' capacity to pay that rent, and where will they pay it from? What resources will they have in retirement? The Pensions Green Paper 2007, that can really be judged as the starting point of the whole pensions journey. I mean, that's when auto-enrolment first came to the kind of mind in the pensions industry. Certainly it was mentioned first in there, and then various ministers brought it on, various iterations. We had various kind of financial disaster, totally and utterly took it off the table, Brexit and whatnot. But now I think it's fair to say we're at a point of no return, essentially, where I think if it doesn't start this year, you're looking at a very short term afterwards. Different approaches. I'm going to touch upon the UK later and just some aspects of their approach, but you can see it worked very well in UK, Australia with their super funds, and also New Zealand. So a good buy-in. People seem to appreciate what it was trying to do and where it was at. So I suppose if we look at the Pensions Green Paper as the first step in this journey, the latest step is the Auto-Enrolment Savings Act in 2024. So this really set out the kind of framework of what is coming down the tracks, what employers need to do, what employees need to be aware of. But like everything else, I suppose the Act just set out exactly what I said, a framework. Practically speaking, it left kind of some employers scratching their head as to what should we do. I mean, the main query, and I'll address it later on, from employers is, what do we need to do? Do we need to get in touch with the revenue? Do we need to get in touch with the body behind auto-enrolment, NACER? Do we have to take an active step here? So I'll explain in a bit more detail what we know about that later on. Next slide, please. Okay, so broad strokes, this is what we know about auto-enrolment, and this is probably a well-worn path at this point, because nothing much has changed here apart from late last year we got the bright snazzy name of My Future Fund. So that's what it's going to be known as. So I suppose from an employer's perspective, you'll need to know when your employees are knocking on the door and inquiring about my future fund and can I join. And I suppose on that point, in terms of timing, it would be good for employers, trustees, and those in the pensions industry to know that there'll be a pretty, I wouldn't say the word aggressive, but a forward-facing advertising campaign coming hand in hand with auto enrollment, very similar to the one that was in the UK, I imagine. Because if we remember, and I'll describe a little bit more detail, the auto enrollment system is going to work kind of like a quasi SSIA that were very successful about 20 or so years ago. So the taxation system is going to be like that, and it's going to be advertised in a similar manner. So it's going to be advertised in a way that says kind of, this is a free benefit for you. You get every €1 for every €3 the employer contributes. It's good news. You should get on board. The problem being, I suppose, excuse me, is when the advertising starts, it may cloud people's view as to what's better, the current scheme or my future fund. Because as the advertising pushes it forward, it's going to encourage these 800,000 people to join the scheme. So it's going to be soft mandatory, auto enrollment with an opt out. I know there were some voices when it was mooted that there should be no opt out whatsoever, but it's going to be a soft mandatory system. There's going to be 800,000 people enrolled in phase one. And that'll be different from how it was rolled out in the UK. In Ireland, it's going to be the employee or the member is auto-enrolled. In the UK, it was a phased enrolment of starting with large employers and ending with the smaller local shops, kind of right at the end of auto-enrolment. There'll be none of that in Ireland. It's the individual will be auto-enrolled for day one. And then the key aspects are, if you're aged between 23 and 60, earn over 20,000 and not already in an occupational pension scheme, you will be auto-enrolled into the AE system. Now, you can also opt in if you're outside of those criteria as well. So there's the ability to actively opt yourself in. Several opt-out points as well. The most important one being 6 months after you're auto-enrolled. And there's a maximum threshold up to €80,000. So just to bring Caroline in here, I mean, Caroline, we've known about these provisions for many, many, many years. Well, I'd say about 3 or 4 years, probably since the framework itself was released. Are you seeing from Aon's clients any confusion, or are they well aware of the kind of bare bones of how AE will work?
Yeah, there's generally high awareness amongst the Aon client base of auto enrollment. But we did a survey last year, and we know that basically at this point last year, 2/3 of our client base had concerns about how auto enrollment was going to be implemented, and just managing, particularly their existing occupational pension schemes alongside potentially employees who may be caught by the auto enrollment piece. So, I mean, I think the design elements amongst employers, certainly the kind of employers that we deal with, which kind of range from small to the very large, is quite high.
Yeah, and that's what I'm seeing too. A lot of employers have expressed a degree of frustration with me that they'd spent a good 2-3 years planning to get their scheme compliant from an IORP2 perspective, or indeed they decided to wind up their scheme and transfer it to a master trust, and now they're looking at, to a certain extent, to that all being frustrated to the extent by the introduction of auto enrollment. So there was a degree of frustration from employers on that point, and a bit of confusion too.
Yeah, I mean, I think if anything's guaranteed in the world we live in today, it's the change is always on the horizon. Yes, I mean, I think some of the frustration from employers, it's not just the administrative burden, it's the cost. And that mightn't necessarily just be to do with the additional contribution cost, but also all of the advice that needs to go with it, the communication strategies, the adjustments to payroll. employers that have already moved to master trust are in a better position in terms of the kind of ease of making changes to their scheme rules, for example, than others who are still operating a known trust, where you're still going kind of the trustee route. But even so, there is still a piece of work to be done. And of course, we have DORA and we have pay transparency and everything that goes with that going on at the same time.
Yeah, busy time. And Catherine, can I ask you, just from an employment lawyer's perspective, uh, are you seeing a lot more queries? Now we'll touch upon the specifics later in terms of from an employment perspective what an employer needs to do. But are you seeing a lot of queries from frustrated employers out there going, "What on earth is this? Is it coming in, and what do we need to
Yeah,
do?"
absolutely. Yeah, yeah. So you know from us working together, Stephen, that certainly when we're drafting new contracts of employment now, and handbooks and things like that, we're drafting them with auto-enrolment in mind, which is a new thing. So we're making sure that employers can get themselves ready in that regard. And then we're getting questions from employers in relation to their existing workforce as well. And I know we'll touch on the kind of technicalities there, but for sure, just seems that kind of in the last couple of months, there's been a flurry of queries on this topic.
Yeah, I'll never complain when pensions is in the spotlight. We rarely make the first two
Great.
pages of the Irish Times, so it's pleasant.
We'll give you
Well, in
that.
a
We'll give you
positive
that.
manner, so it's a pleasant change.
Yeah.
Next slide, please, Sinead. Okay, so I think we're all aware of the design and the contributions, and I suppose this is where you really have to focus on how much is it going to cost me? What is this going to cost in terms of additional contributions? You can see for the first 1 to 3 years, the employer contribution starts off pretty low, so 1.5%, moving to 3 and then to 6 eventually. So the golden percentage right at the end is 14%. So 10 years plus and an employee will get 14% into the scheme. So I think for years that's been touted as the preferential lowest percentage rate that an individual should be putting into their private pension to get a decent replacement income in retirement. There was talk about having different contribution rates, but I think they landed at something that is preferable, it's a kind of slow burner that it doesn't land an employer immediately at 6%, which would have been hard to take, and it starts at something which isn't insignificant. But if an individual simply maintained a 1.5% contribution rate till retirement, their pot wouldn't really be sufficient to have any sort of income. One of the aspects, I suppose, that's driving people towards maintaining, and we'll discuss this a bit more detail, and sticking with the existing pension scheme is the fixed structure of this contribution structure. So there's no possibility here to contribute AVCs. You pay, the employer, and the state pays whatever's mandated here. So there's no top up allowed. The employee can suspend contributions after 6 months, but there is then going to be a process of re-enrollment and putting the employer in and out, which will be difficult, I'd imagine, to keep track of. But NASRA, the body I'll discuss in a bit more detail later, they'll be tasked with managing that. That won't be an employer's role whatsoever. 3 different investment funds. So there was initially going to be 4 different funds, but now they've opted for 3. So it's simply going to be low, medium, high. The investment tender went out this week, actually. And the tender was useful in that it kind of gave a bit of colour to various different aspects of the auto-enrolment design. So I'm going to touch upon that a little bit later and just highlight what we've learned from the AE system from that tender. Drawdown, that'll be at state pension age. So the individual will draw it down at the same time they take their state pension. And if they choose to defer it, as you now can, in return for a higher state pension, then your auto-enrolment will also presumably be deferred to that date. This, as I described later, I think the state was very pleased with the manner the well, pleased is one word. I think at the end they were a bit overwrought by the number of SSIAs taken out, but they were very impressed by the take-up SSIAs. So they adopted this approach as opposed to the existing tax relief system with occupational pensions in Ireland. So as I said, basically speaking, it's like €1 for every €3 the employer contributes. And I'd imagine that's the way it's going to be advertised to individuals, making it very popular and something employees want to engage in. If you look at it, it's an effective tax relief of ballpark 25%. So you can see that individuals who are at the higher tax rate, 40%, would still be better off in their own existing scheme, whereas individuals at 20% might benefit from auto-enrolment. But then again, there's a host of different elements to consider when you look at one of the key questions, which is, am I better off in auto-enrolment or am I better off rowing my own boat, be it in an occupational scheme, a PRSA, or my own arrangement? Next slide, please. Okay, so I mentioned this body numerous times already. So the body that's going to be charged with oversight of auto-enrolment is going to be the entity known as NASRA, so the National Auto-Enrolment Retirement Savings Authority. So they're going to be responsible for all communications with members. So irrespective of who the investment manager is, be it Irish Life or whatnot, the body charged with the overall communications to an individual will be NASRA. So when a person opens an email, opens a letter from auto-enrolment, it's going to be from NASRA. You can see recently, last year, Tata Consultancy Services, so they were awarded a 15-year contract to administer the scheme. And that can provide a degree of confidence because Tata have vast experience they were in charge of Nest, the UK system, which has gone pretty well over in the UK. So they kind of know what the wrinkles are and hopefully know how to iron them out. The investment managers, 3, are going to be appointed. That went out to tender this week. I'll discuss it in a little bit more detail, but the closing date for that tender is the 7th of April. NASRA, to the best of my knowledge, there have been no board appointments or CEO appointed to NASRA, and I don't know whether the overall plan is to hire those individuals from within the civil service or look externally. And I suppose they're the two bullet points here, the two kind of areas where I kind of have concerns that these elements can be met by the 30th of September deadline, even with the typical summer period in Ireland, July and August, or even into September, could slow things up. So you have to consider the 30th of September with a big question mark, I'd imagine, behind it. But hopefully, and I think there's no option for employers or anyone in the pensions industry but to steam straight ahead and plan and have everything in place for well before that rollout date. And for various reasons, I think it makes perfect sense to get one's house in order before that date. Next slide, please. Okay, so this is the investment manager's tender, and I pulled a bit of information from it. It received coverage this week as well in the Irish Times. As I said, closing date for the tender is the 7th of April. And you can see from a purely financial point of view, it would seem to be very, very attractive in that after 10 years, you're going to have 21 billion of assets under management. So quite large numbers that will grow significantly over time. Now, the next bullet might be the one that would lead to some reluctance from investment managers. It's a quite low cap on an annual management charge of 0.1 of assets under management. And then if we look at what the department's looking at in terms of awarding the contract, you can see the most marks for the tender, 40% will go to the lowest annual management charge. And we can debate whether or not we want to do that. Is that preferable? I think from a public buy-in perspective, and certainly one of the issues the public seems to have with pensions over the past 2 decades probably, has been charges. So I think to get over that hump, there has to be a kind of significant focus on keeping the charges low. 21.5% of the tender marks will go to the design of the funds. Experience and management team, 10% of the marks, and then sustainable investment, social responsibility, 9.5% of the tender marks. So everyone's going to enter, once again, this is set out in the tender document, but it's useful for us to know. Everyone will enter a default strategy, which is appropriate to their age. So less than 5 years from age 66, you'll go into low risk. Greater than 5 years, but less than 15 to go until you reach age 66, you'll go medium risk. And anyone who's younger than that will automatically go into high risk. And once you join, you're free to select whatever the 3 funds you want. Interestingly enough, and I think we were aware of this now, but it's good to put it out there the way we're all fully aware, is that the funds will be pooled across all 3 risk levels. So the members at each risk level will receive the exact same return, irrespective of the investment manager that actually held their resources. So if you're at high risk, you'll receive the exact same return, irrespective of who is actually managing your resources. Now, I'll leave that to the investment managers, whether that disincentivizes them in it, not taking risks, but being creative in terms of obtaining investment return. But that is probably the preferable design from the point of view of NASRA. Caroline, can I bring you in there just on the investment manager's tender? You probably had a chance just to glance over it. Is there anything in there that you think is noteworthy, or is there anything that caught your eye in terms of the charges or the design or the funds?
Yeah, sure. Yeah, it's interesting in terms of the cap on the AMC. There's no mention of total expense ratio in any of the tender documents, and it does refer in several occasions to the AMC being all inclusive. So it would suggest that it's not an AMC in the way that we understand it, where transaction costs, etc., are on top. That almost that the AMC is going to have to is going to be like a TER, so 10 bips or 0.1%. So that wasn't particularly clear for me, but certainly my reading of it is that AMC almost equals TER here. So it's not only that it's going to have to cover the investment manager costs, but there's all of those other bits that are normally covered in the TER are going to have to be captured by that 10 bips then as well, potentially. They're obviously trying to keep everything within this kind of overall magic kind of 50 bips, 0.5% that they've mooted before. Administration charges, we haven't had any clarity in terms of what exactly that's going to be. It will be a weekly flat charge. We've heard 50 cents referred to. So that will be on top of what members are paying here through the AMCs as well. But again, all designed to kind of come in under that overall maximum 0.5% of the assets that the government is aiming for. Other than that, nothing really surprising. It had all been well flagged. I suppose it was more the timing of it. It does mean that there's a lot of work still to be done between now and the end of September. And as you say, it's increasingly likely that 30th of September date is going to get pushed out.
Yeah. We're used to moving deadlines. So on this, when I look at my previous presentations, I had deadlines that have come and gone.
Yeah, I mean, I was just looking. I did a presentation last year, and in September, and the date at that time was 1 January 2025. So theoretically, we should have auto-enrolment up and running by now.
Yeah. The one thing that strikes me, and I don't know, I'm at a remove, obviously, from the investment management side of things, apart from advising a number of investment managers, but it would seem to me that there may be a conflict with the investment managers in that they have their own range of products, which probably have a more favorable charging structure and probably a degree of less hassle, will we call it, or oversight in terms of the product. and they prefer an ideal world for the public to perhaps buy into those existing products rather than this. And I don't know, would it create conflict in those entities? And perhaps it is. I don't know, as they look at this tender and decide whether or not to actually go for it.
Yeah, I mean, it is quite an ask. Obviously it's anticipated that it will build up to 21 billion over 10 years, but you're effectively starting at zero. So there's going to be a leading period where those investment managers are not earning anything really. Um, it's obviously all going to be passive management. I think the kind of pooling will constrain, I suppose, any motivation for innovation. This is all about low risk. It's all about low cost. And perhaps looking at what the UK did with Nest, that may make sense. We're trying to build up employee confidence in the AE system. Starting out, we don't necessarily want to do anything that may carry higher risk or certainly higher cost.
Yeah. Gordon Gecko needn't apply sort of
Yeah.
vibe I got. All right. Next slide, please, Sinead. Okay, and this is a very brief. I have two slides here because I know the key here is I'd like to really touch on the employment aspects and the practical role, what we have to do. So then the act itself, I mean, if you look at the act, and I think every pensions lawyer has several copies of it that they're leafing through. The key is actually setting up NASRA, how it'll be put together. But one of my favorite elements actually, and the one that I think will probably matter most, will be the review that will occur after 5 years. And you can see in the act it actually sets out what will be reviewed after 5 years. So the earning threshold, the 50k limit, the age criteria, the 23 to 60, employment status for enrollment, which I'm going to touch upon later with Catherine, because the unfortunate situation is that self-employed individuals won't have access to auto-enrolment. The provision of insurance and other benefits with NASRA, because what I have seen is companies and employers may have pension schemes, and they may have risk benefits, be it life assurance or PHI tied into those benefits. And then if they kind of neglect or move away from those and head towards an auto-enrolment solely environment, there may be issues in terms of not bringing those benefits along for new hires. So NASRA have kind of alluded to the fact that they'll have a look at that. The range of providers, so be it investment managers or maybe the administrator, but the administrator has a 15-year contract. Contribution rates will be looked at, and then drawdown options, because the drawdown options for the AE system are essentially the exact same for our private DC pension. So at retirement, you have your pot of cash, you can take your tax-free lump sum, and then essentially you go to the private market to purchase your retirement benefits. The Pensions Authority, they have to prepare a supervisory report on the performance of the authority, on the performance by the authority and the board. So there will be oversight of NASRA. It won't be simply out there on its own. Next slide, please. Okay, so some key takeaways from the Act as well. So exempt employment can be where an employee or employer can make contributions to the scheme. So as I mentioned earlier, to not be involved in auto enrollment, you have to have access to an occupational pension scheme. And if either the employer or the employee is making contributions to that scheme, then you needn't go down the AE route. Now, there are important employment law aspects to do with that. For instance, there could be issues, as I see it, if the individual opts out of the scheme, they immediately fall into the AE net. And then if the individual leaves the scheme for any other reason, even mat leave, I think could possibly be an issue under the Act. But I'll bring in Catherine here if it's probably a good time.
Sure.
Catherine, in terms of auto-enrolment, I suppose we can look at it in two baskets, and I know in the advice we've given today, it is basically two baskets being the view on new employees and the
Mm-hmm.
view of current employees. And I suppose current employees can be split then into employees who are currently not members of a pension scheme and employees who are members of the pension scheme. So if we look at new hires,
Yeah.
what are we looking at in terms of advising employers on what to do going forward in terms of template contracts and whatnot?
Yeah. Well, I guess, I mean, it comes down to what the employer wants to achieve and where their concerns are, because obviously an option for them is, you know, just to let auto-enrollment happen. And you might then end up having kind of what's been referred to as a dual scheme. So there are issues though with that, of course. You're going to have different administrative levels, maybe different costs, kind of two cohorts of employees. So if it's important for our client or the employer to have a single scheme arrangement and they have an occupational pension scheme in place, with regards to new hires, we've been talking to them then about making it a condition of employment from day one that that employee will join the pension scheme and will remain a member of the pension scheme. So that's what we can do on the employment side in the contract. And then if the employee signs up to that, then all good so far. And then, Stephen, we talk to you and your team about the advice that the client needs in terms of making sure that their occupational scheme allows for that. So making sure there are no 6 months service provisions in terms of eligibility and that kind of thing. So that's kind of so far so straightforward with new hires. And we talk to the client then with you as regards to what those contribution rates might look like at the start of employment. And what you can do is have them join at a default contribution rate of 0% and have the employer contribution rate to be something that is more attractive than auto-enrollment. So as we know, it's currently 1.5 employer and 0.5 state. So if they make that employer contribution rate 2% or higher, then it'll be more attractive, hopefully, than the AE, and you'll get that employee buy-in. And I think tax-wise, it might be more beneficial, but I'll leave that to you and Caroline to opine about. So then, yeah, we just make sure that the rules, if they need to be reviewed and amended, they are. So that's what we would do for new hires. I think, and we can talk about this more maybe when we look at existing, we just have to be mindful of a couple of things, amongst other things. But one is employers can't make unlawful deductions. So employers will be aware of this. It's the Payment of Wages Act from 1991. So we're all aware of Section 5, unlawful deductions. There are 3 times when you're allowed to make a deduction from an employee's salary. So that is one where they have signed up to it in their contract, like a pension contribution. 2, if it's required by law, so PRSI would be a good example there. Or 3, where the employee has signed up to it in writing. So if you can't bring yourself into that, you just need to be careful about making employee contributions without their consent. So hopefully that's clear in terms of new hires anyway.
Yeah, the new hire one, and it's definitely because I chatted to a few life officers on this as well, because I suppose one of my concerns was if we include it in the contract, but then the individual has to engage with Zurich, Irish Life, Aviva, whoever it is, and actively click a button or click some sort of form to be admitted to the scheme. And I've been assured that no, once the employer slots them in, there's very little engagement, because I suppose I'd be wary on an employee kind of just kind of acquiescing and not really taking any sort of affirmative action to join the scheme, even though he or she have been put in. But I think a lot of this will come out in the wash, because
yeah, I think so.
I think we're seeing the exact same queries with different spins on them number of times.
Yeah. Yes. And then the other query then is, can we keep them there forever and ever? And I think, for new hires, as I said, you can make it a condition that they have to join and that they will remain. I would be wary, though, about sort of, making someone stay in a contract or in an occupational pension scheme. And of course, another thing that we really need to think about is there is protection against penalisation in the Auto-Enrolment Act. So that's section, I'm going to say 127, I think, or thereabouts. But that is for an employee who proposes to participate in AE or indeed participates in AE, that they can't be penalised. So if an employee really wants to join AE, you need to be careful about, an absolute outright refusal.
Yeah, because I'm gonna have a wild guess. I've seen some of the template ads now. I haven't seen anything in terms of radio or anything like that, but I'll have a wild guess that a lot of people on this webinar come probably August, September are going to be inundated with individuals who are either in their own occupational pension scheme or are going to be admitted to it who will say, I want to go into the AE route because look at this ad with Johnny Logan in it or whoever's in the TV ads, whatever celebrity we're going to get. This sounds fantastic. It's like the SSIA. I had one of those back in the noughties. It was magic. I bought a conservatory with it. I want to get into this AE system. So I think it's going to cause a headache for a lot of individuals in HR in relation to managing. And in a later slide, I call it there's only one. But I think I'm going to change that slide to there's always a few who people just want to get into the AE system by virtue of the fact it's on billboards. It's being kind of waved around as being something you have to get involved in.
Absolutely. Yeah. Sorry, Caroline, go ahead.
Sorry, if I can come in there. I think the communications piece is going to be really important here, and almost creating straw men that demonstrate to these kind of employees that, if you're on an X salary, this is what all the things you're going to get on your occupational pension scheme, and this is what the overall value of it is relative to what you're going to derive out of the auto-enrolment scheme. And I think when you put something like that, a very simple one pager in front of someone, and it's kind of brought down to pound, shilling, and pence, that will help, counter some of that sort of media frenzy, let's say, or fear of missing out, that's going to be generated when we really start pushing the AE publicity boat.
Yeah, definitely. It's definitely got potential for FOMO. I think that's my shorthand. Well, it's not the only acronym I know, but one of the very few. Okay, I know I can see we've and I should have said this, sorry, if anyone's got a question, please submit it with the Q&A. But I see we've got a load of them. So I'm gonna try and short circuit some the way we can take as many of those at the end as we can. So just on the Auto Enrolment Act, and we're going to go back, and I'll go back with Catherine as well, just in relation to current employees, what we can do there as well. So just in 2 seconds, we'll have a look at that. But it's important to also remember that the moment for an occupational pension scheme to bring it down to, you don't have to go down the AE route, there'll be no minimum stipulated contributions. But the Act says that these will be set by NACER and the Pensions Authority no later than years 7 to 9. The Act contained a lot of information. So if you're in the investment management business and you are going towards the tender for auto-enrolment or involved in that, I would flag that there's a lot in the Auto-Enrolment Act that would be relevant to that tender, and it's relevant to the roles that the investment managers will play. Next slide, please. Okay, this is my growing slide, and this is definitely where I will need Catherine and Caroline's assistance here. So issues with auto-enrolment, and I suppose this can be flagged as being where HR, employers, trustees of pension schemes, indeed anyone with the pensions industry are going to come across these. First issue is probably taxation. As I said, the taxation system for auto-enrolment is going to be similar to the SSIA, so it won't be the tax relief system. So that will create a lot of questions and issues. And I think Caroline mentioned it just there. I think in terms of getting around a taxation problem and improving people's take-up of existing pension schemes, it's important to flag, okay, in pennies and pounds, this is what you're getting in your existing PRSA occupational scheme. this is what you'll get under AE. So I think that'll help. Secondly, in relation to self-employed people are not going to be, won't have access to AE. Now, it seems pretty unfair, and I know there is a quite amount of disquiet about the fact that self-employed people won't have access to this. And I'd imagine when it starts advertising AE that there'll be more disquiet. But is this, Catherine, do you see it a problem that AE won't be there for self-employed gig workers and whatnot? Is that
I think it
would
will
that
definitely.
rankle with you?
It does a bit, yeah. Yeah, no, for sure. The focus of auto-enrolment is on paid employment. So it is a shame that the scheme hasn't sought to kind of look at those structural inequalities as regards perhaps, as you say, gig workers, and of course women as well. There is a concern that although the auto-enrolment scheme will increase pension coverage overall, that it may impact adversely on the gender pension gap, which is currently 35%. So again, as I said, the focus being on paid employment, people who are in, caring roles in the home or low paid roles, because of course there is that 20K threshold as well, won't get brought into this. So yeah, that definitely would be a cause of concern for many.
Yeah. Okay, and then other issues that I'll just quickly flag: challenge for payroll providers. I think that's probably less so, and I'll flag why that is the case in next slide or so. Administration challenge, millions of transactions per month. Hopefully the appointment of Tata, who are used to far more a bigger scheme in the UK, will assist there. Standard fund threshold issues. I suppose this is definitely a first world problem. Standard fund threshold is about 2 million euros. And if you were advising an individual that, hey, Stephen, you're heading towards the 2 million euro pension pot, you need to stop contributions to your pension scheme. If by virtue of auto enrolment you suddenly have to go back into a pension scheme, that could cause an issue. Somewhat alleviated, I suppose, because the standard fund threshold is going up over the next few years, so possibly not the issue that it could have been. Employers unable to enroll. This is an issue. I think definitely when the whole consulting period on the Act, employers definitely and employers' bodies were definitely looking at ways in which they could nominate their own scheme as fulfilling auto enrollment and force employees to join the scheme instead of going around the kind of complicated, well, not a complicated, but somewhat intricate process of looking at the scheme and trying to get existing employees into it. Difficulty in employees leaving AE system to join employers plan. Yeah, there's going to be an intricate sort of dance in relation to coming into AE and existing occupational pension schemes and how they both sit together. UK, I've flagged that. Lack of fund choice. That was mooted that 4 funds, it was initially the view were too low. I think it was just right. And I think 3 funds is even better, to be honest with you, to get buy-in to it. So I don't think that's an issue. Managing opt-ins and opt-outs, that's going to be an absolute nightmare from a logistical and administrative point of view, but that is going to be NASFA's problem. Now, I can foresee issues down the line, and employers need to recognise from their own workforce who is in what pension scheme, but hopefully that won't be as complicated as it seems. New hires, I discussed that earlier with Catherine, just in relation to new hires and a potential solution there. And then on the current employees, so we'll bring Catherine in here. I've put it as encourage them to join the existing pension scheme as being an option. But what are we looking at in terms of current employees, Catherine? If you remember earlier, I referred to them being in 2 buckets, being current employees who are members of the pension scheme and current employers who aren't members of the existing pension scheme.
Okay, so your current employees who aren't members, I guess, might be the biggest cause of concern, because they will they won't get embroiled in AE as long as someone is making a contribution, whether it's them or the employer. But if they're not in your scheme, they will get caught by AE. And if you want to avoid that and have a single scheme approach, we should look at our existing employees not in this scheme. So in terms of how we can encourage them to join, there's certainly an education piece, as Caroline mentioned. From an employment contractual perspective, we've spoken about how we can't force employees make contributions because that could be potentially an unlawful deduction. And also then sort of forcing employees to join the occupational pension scheme, that would be a change to their terms and conditions of employment, which you really can't do unless you consult, get their consent. So, I mean, all of those things are worthy of lots of discussion. But one thing that I know me and you have been talking to clients about, Stephen, is another option potentially of writing to your employees in good time and say to them that they will be enrolled in the occupational pension scheme by a certain date, which is, well before the rollout of AE. So you would enroll them then at 0% employee contribution rate, so avoiding any question of an unlawful deduction. And the employer contribution rate then would be 2 or more to compete with AE. So they're not at any financial loss. And then you would also sell to them the benefits of the occupational pension scheme, perhaps more flexible in terms of contributions, higher returns possibly. And then, they can amend those contribution rates should they wish to go higher. You'll have their consent for that higher contribution then. And then you can say to them, look, if you have any concerns, contact someone in HR by a certain date. And that would hopefully bring us over the consultation piece. So that's one way of potentially drawing our existing employees into the occupational pension scheme if they're not there already. And again, I would just, highlight the risk of penalisation under the Auto-Enrolment Act. So if someone really wants to join AE, let's just be wary of, an outright refusal about that for fear that you might get caught by that penalisation.
Yeah, yeah, and where I presume, because you're going to have employees in years to come coming from employment where they have been in an AE scheme, have been in the AE scheme, and they're moving to employment where the employer has a pension scheme, and the employee could be quite reluctant to go down the occupational pension scheme route because they quite like how AE worked and
Yeah.
the communications and whatnot. So there's going to be new issues from employees. I don't think it's going to end on the 30th of September.
No, I think that'll just be the start, as you say. Well, hopefully not the start, because there's lots of work we can do before then. But a lot of it is going to come out in the wash and see how things go and if there are any cases on penalisation and that kind of thing.
Yeah, perfect. Next slide, please. I know I'm going to skirt over some issues here. Okay, I'll move on to the next slide because I've flagged a lot of these issues. Next slide, please. I'll go to it. Okay, so this is where I want the Department of Social Protection have a quite useful Q&A. And I think from a practical point of view, it answers a lot of questions. Now, just for time constraints, I'm not going to go through each of these, but you can see like some of the, the questions relate to topics we've discussed today. So what's best? Auto-enrollment or existing scheme? And you can see the response on the Q&A is the best option for you depends on your own circumstances, taking into account factors such as tax relief, contributions, fees, and fringe benefits. So it's a quite practical document, actually. Various different questions. Would there be exemptions for small employers? No, small employers will have to adhere just as well as the bigger employers. Definition of employee. It's going to be the exact same as we have under the tax acts. And I suppose the key one from the Department of Social Protection, what I gleaned was that they're going to be pulling the information in terms of employees and whether they're eligible from payroll data. So if you're if you're paying into a private pension scheme outside of payroll, they won't be able to see that. And there's a potential for you to continue paying into your private pension scheme and also be admitted into AE. Now, that will cause a headache later when the private pension scheme has to be unraveled for if you're getting the dual tax benefit, but there could be potential issues there. Next slide, please. Okay, you can see in relation to, there's going to be an employee and employer portal. For the employee to access the portal, they have to have a MyGov ID. And I know lots of people will be familiar with these. I found it to be a bit of a nightmare, to be honest with you. I had to get one to get my latest driving license, and to be, I just gave up and went in. So there's going to be an administrative headache in terms of people getting MyGov IDs. For the first few years, any pension contribution greater than zero will be enough to be exempt. So it did say in the Act that once the employer or employer contributes, but the Q&A specify that once the contribution is greater than zero from the employer or the employee, it'll be an exempt qualified scheme. Next slide, please. So this slide is useful, and I think it might actually, the slide deck will be circulated, but this kind of answers the question as to what do we actually have to do. So I have cut and pasted into this slide what practically an employer needs to do. So once an employee has been identified as eligible, NACERA will send you an AEPN through your payroll software system. They'll inform you of the contributions the employee needs and the percentages. So everything you can see from the bullets here, everything is designed to be simple and painless. There's very little for the employer to actually do in the AE system. Now, there is integration with the payroll software, but I think that, from what I hear, is being worked upon by the payroll providers at the moment. And NACERA, they're going to have to be responsible for that. So that slide just sets out practically what will happen, and it will involve NACERA communication with the employer and very little from the employer to do. Next slide, please. Enforcement, I suppose what I want to flag here is probably in Catherine's domain. The WRC will be responsible for dealing with cases where employees are hindered from joining auto-enrolment and penalised to do so. So we've got to tread carefully in relation to, whilst fostering a desire and a willingness to join an existing pension scheme, that's got to be measured also with blocking access to auto-enrolment. And you can see there'll also be a list of employers published, similar to the tax defaulters list, and convicted of non-compliance. So two very unpleasant consequences of non-compliance. Next slide, please. Okay, I am going to actually opt to go to the Q&A instead of looking at the UK experience, because I think it'll be more worthwhile. We have a mountain of questions to go through. Okay, so I'll start with, there are rumours that the launch date will be pushed out again. So why should employers engage in preparing for AE now? Caroline, can I flag that with you and see what you think?
Sure. So if the launch date is pushed out, and it is looking increasingly likely, then that is a boon to employers, but it doesn't mean that you can drop AE and just think about it in 6 months' time. There is a huge amount of work to do. If you have an existing occupational pension scheme and you want to minimize or avoid altogether your exposure to the AE scheme, you need to start to assess what the cost implications are going to be, what you need to manage the whole compliance piece, including changes to your employment contracts, changes to your pension scheme trust deeds, eligibility conditions, etc., etc. What the payroll implications might be if you are caught by AE, what it looks like side by side. You're going to need advice on that, consulting advice, legal advice. Once you've decided on your way of going forward, including things like Catherine's called out, like whether you have a cash agreed where employees pay 0 and the employer pays 2, you need to have a plan of action to implement that, which also encompasses things like communications. And I mean, that will be a big exercise in itself. So I would say that if it is pushed out, then that's a good thing, because it gives you an extra few months to get through this mountain of work. And don't forget, there's a 13-week look back period. So even though it might be pushed out to 1 January, technically revenue is going to be looking at who was paying contributions in the 13 weeks prior. And so anybody that wasn't having contributions paid for them or by them is going to get caught by auto-enrolment unless you've dealt with all of these issues before the end of September, assuming a 1 January launch date.
Okay.
Hopefully that covered it.
But yeah, no, thanks a million. Okay. An employer doesn't have to make their own scheme more attractive than AE, though. Or did I take up Catherine up incorrectly? I think I can help out that. No, I think what we mean is to get around the issue of an individual wanting to get into AE and you had your bright, shiny occupational pension scheme. I think you have to match the contributions. Theoretically, you could have a pension scheme with 0.1% contribution rate employer in it. And AE will be better, but you could also flag that will be meet the bar set in the National Auto Enrolment Act for an individual to participate. So I don't think it's a question of making an existing scheme more favourable. I think it comes down to the education piece in terms of existing employees and how you have to encourage employees to engage, look at the existing pension scheme. But once again, the Act is clear. You can't bar someone from entering the auto-enrolment, but I think you would reduce the administrative not nightmare or heartache of operating two different kind of pension arrangements by encouraging people into a scheme that you've set up, spent money administering, and I think that is probably the preferable route. One more. If an employee has main employment elsewhere that is pensionable, how does this impact their ad hoc employment with the other employer? I suppose I'll take that based on the Q&A. It all comes down to, I suppose, two key things. That if you look where they're pulling their data, they're pulling it from the revenue payroll data. So once they have information that the individual is over €20,000 being different deployments and it's being taxed and paid through payroll, or once the information highlights that the individual is 2360, they'll be auto-enrollment. They'll be auto-enrolled. So it'll come from the revenue payroll data. That is the key element that NACER will be looking at in terms of enrolling or auto-enrolling individuals. Now, just looking at the time, I see it's heading towards 12:05. So I don't want to keep people any longer. And I know there's a mountain of questions here. And I'll do my best along with Caroline and Catherine to get back to any of those individuals. If their details are left there, I'd be delighted to get back with the Q&A. And it's obviously a topic that still is very relevant and one that people are very interested in it. In terms of follow-up, could people actually complete the questionnaire that'll be sent around? Because once that's completed, then we'll be able to send on a CPD cert where you'll be able to gain CPD. So with that, I'd just like to thank Catherine and Caroline for assisting in today's webinar. Hope it was useful and prepares people for the looming 30th of September or later deadline. So thank you, everyone.